Hey! Welcome back. Or if you're new here, you picked the right day to show up. What I'm about to tell you might change how you look at money forever. No fluff. No jargon. Just the stuff that actually matters. Let's get into it. Most investors lose to the market not because they're lazy, but because they're trying too hard. That single mistake quietly costs people decades of wealth. But there's one investment that just keeps winning. Quietly. Consistently. Year after year. It's called the S&P 500. The S&P 500 tracks the 500 biggest companies in America. Apple. Google. Amazon. All of them wrapped into one single investment. You're not picking one horse and hoping it wins. You're buying the entire racetrack. And that changes everything. When one company fails, 499 others keep going. Your money never depends on a single bet going right. That's called diversification. And it's honestly the closest thing to a free lunch that investing has ever offered. Seriously. Now let me show you what the numbers actually look like. Because this part, nobody talks about this enough. Over the last 30 years, the S&P 500 returned about 10% per year on average in nominal terms, roughly 7% after you account for inflation. Put in $10,000 today. Leave it completely alone for 30 years. You could end up with around $174,000 in nominal terms, though inflation and taxes will affect your real purchasing power. You did nothing. Zero stock picks. Zero stress. Zero late nights reading earnings reports. The market did all the heavy lifting for you. That growth comes from compounding returns. It's money making more money, which then makes even more money on top of that. Think of it like a snowball rolling downhill. Slow at first. Almost boring. Then suddenly, unstoppable. Time is the hill. But here's where someone always raises their hand. What about crashes? What about 2008? What about 2020? Fair question. Yes. The S&P 500 crashed. Hard. Scary hard. But here's what nobody tells you when it's actually happening. It always came back. Every single time. And it didn't just recover, it came back higher than before. Every single time. Selling during a crash is like walking out of a restaurant because your food is taking too long and then still paying the bill on your way out. The investors most hurt by crashes are typically those who sold at the bottom. Long-term patient investors generally saw their money recover, though recovery can take years, and timing matters if you need the funds. So how do you actually get in? Simple. You buy an index fund that tracks the S&P 500. That's it. Look for tickers like VOO or IVV for the lowest costs, or SPY, the most traded, though slightly pricier. For long-term investors, VOO and IVV are generally the better value. The fees are almost shockingly tiny. Some charge as little as 0.03% per year. That's 3 cents on every $100. Now compare that to a managed fund charging 1 or 2%. It sounds small. But over decades, that gap silently destroys your returns. If the world's greatest stock picker doesn't trust stock picking for the people he loves most, maybe you don't need to pick stocks either. Start small. Even $50 a month builds something real over time. Consistency beats a lucky windfall every single time. One index fund. Historically around 10% average annual return, though past performance is never a guarantee. Decades of patience. That's the whole strategy. You've already got it. That's a wrap. If this hit different, smash that like button right now. I drop a new video every single day, subscribe so you never miss one. And seriously, comment below, what is the number one money mistake you've made? I read every reply. See you next time.